AI spending, energy shocks, and crowded equity positioning are pulling asset classes in different directions at the same time, making today a pivotal moment for cross-asset risk management. This is vTalkInsight, Allocator's Lens Daily for July 17th, 2026. We will connect how the AI capital expenditure boom, shifting rate expectations, and persistent geopolitical tensions are reshaping the balance of risks across equities, bonds, credit, currencies, and commodities. In equities, the core story is that earnings momentum is finally broadening beyond the narrow AI and mega-cap tech complex, even as concentration risk remains elevated. Previously lagging sectors and regions are starting to participate, with financials, capital-heavy industries, and select emerging markets showing clearer signs of earnings recovery and re-rating potential. Broad forecasts calling for earnings growth in the mid-20s this year point to an unusually strong and broad-based profit cycle, more typical of post-recession rebounds. Large U.S. banks are reporting record profits, boosted by strong capital markets activity, accelerating loan growth, and very low credit provisions, and their stocks have outpaced the wider market since late last year. Capital-intensive areas such as energy, renewables, defense, and telecoms are expected to deliver high teens earnings growth, helped by renewed infrastructure and reindustrialization spending. Airlines are raising guidance despite record fuel costs, as robust travel demand and pricing power more than offset headwinds, while value-oriented financials and insurers trade on low earnings multiples and continue to return capital. Against that constructive backdrop, the equity risk lies in how dominant and fragile the AI trade has become. The S&P 500 is increasingly driven by a handful of large technology names, and U.S. equity positioning is at its heaviest overweight in years, which reduces diversification and leaves the index more sensitive to sector-specific shocks. TSMC's very strong results, upgraded sales growth above 40%, and sharply higher capital expenditure guidance show how powerful AI demand remains. Yet its shares in the broader semiconductor complex have underperformed as investors question how long this Capex surge can run. There is a growing sense that the AI infrastructure build-out has bubble-like features, with over $1 trillion of planned tech spending increasingly financed through capital markets rather than free cash flow. Authorities are monitoring leverage tied to AI valuations. AI-related stocks are trading with elevated volatility, and semiconductor declines look more like a momentum unwind than a fundamental collapse, underscoring how high the bar for earnings has become. At the same time, emerging markets such as China, Korea, Taiwan, and India are seen as attractively valued with scope for an earnings catch-up, while UK equities sit in a more neutral spot, supported by foreign bid and buybacks, but hampered by domestic outflows and politics. For allocators, the equity focus now is on whether broader earnings strength can offset AI concentration risk, and how sensitive this wealth effect-driven economy has become to any equity correction. Turning to rates, bond markets are caught between encouraging disinflation signals and renewed concern about supply-driven inflation from energy and food. Recent U.S. consumer and producer price readings have come in softer than expected, and that has helped pull yields back from their highs and pushed out the timing for any additional Federal Reserve tightening. The prevailing base case is that policy rates stay on hold through year-end, with scope for a couple of cuts next year, although the overall outlook has become more ambiguous than the earlier, clear-cut expectation of imminent easing. At the same time, the yield curve still signals tension rather than relief. Short-dated yields have eased somewhat, while the long end remains elevated above 5%, highlighting limited comfort for longer-duration bonds and ongoing concerns about inflation premia and term supply. Food prices have jumped by around 10% in a month. Middle East tensions are embedding an oil risk premium, and AI-related energy demand is raising questions about the cost of power, all of which support the idea of more volatile inflation rather than a smooth glide back to target. Outside the U.S., bond markets are also diverging. European core yields are grinding higher, reflecting stagflation worries, while UK yields have been steadier as a softer growth outlook and a more market-friendly chancellor designate temper expectations for aggressive tightening. Commentary suggests that if the Fed is ultimately forced to hike again to re-anchor inflation expectations, long-term yields could actually fall as inflation premia compress, a scenario that might briefly support risk assets even as policy tightens. For rate-sensitive allocations, The key watch points are upcoming inflation and labor data, the evolution of energy prices, and any signs that foreign demand for long-dated treasuries is being eroded by ongoing Chinese selling or Japanese repatriation. In credit, conditions remain broadly supportive, but the sources of strength are increasingly intertwined with the same AI and energy themes. Major U.S. banks have delivered record-breaking profits and trading revenues, helped by high asset prices, heavy issuance, and strong loan growth, while credit quality and provisions remain unusually benign. Deregulatory trends are allowing banks to regain some lending share from private credit providers, and expectations for a very active year in equity and debt capital markets are feeding a virtuous cycle for bank earnings and for fee-driven business models. Beneath the surface, however, leverage tied to the AI Capex boom is rising. Technology and infrastructure projects are being funded heavily through capital markets, pushing up competition for funding and adding to upward pressure on government bond yields. Spreads on AI-linked debt have started to widen, signaling growing skepticism about whether these investments will generate cash flows in line with expectations, and the decision by a well-known hedge fund to gate withdrawals after poor performance underlines that not all parts of the alternatives complex are sharing in the current strength. There are also areas that stand out as relatively resilient in this environment. Infrastructure-related debt is seen as attractive as policy and permitting constraints hold back new projects and increase the strategic value of existing assets that benefit from AI, electrification, and reshoring trends. At the same time, higher financing costs have raised hurdle rates for private equity, shifting the emphasis for financial engineering to operational improvement and reminding allocators that the credit cycle will eventually normalize from today's unusually low default and provision levels. The key systemic risk flagged is a shock to credit availability or a forced Fed tightening in response to inflation that could abruptly slow the AI investment engine and test some of the more leveraged balance sheets. In foreign exchange, the clearest near-term move is in sterling. The UK economy delivered a modest upside surprise in May growth, and reports that a centrist, fiscally disciplined candidate will become chancellor have been welcomed by markets. Sterling has rallied to around a one-year high, while gilt yields have edged lower, as investors take the view that the Bank of England can monitor food and energy-related inflation risks rather than rushing into tighter policy given slack in the labor market. The dollar, meanwhile, remains underpinned by a combination of resilient U.S. growth, delayed expectations for rate cuts, and its role as a safe haven in the face of geopolitical tension. AI-driven Capex and equity market gains are supporting domestic activity, even as inflation volatility complicates the Fed's job, which tends to keep U.S. yields relatively attractive. From a cross-asset lens, prior patterns of carry trades funded in lower-yielding currencies, such as the yen, remain an important background factor, while the recent move in sterling highlights how quickly FX can respond when growth data and political signals shift at the margin. On the emerging side, equity markets in China, Korea, Taiwan, and India are seen as attractively valued with scope for earnings recovery after underperformance, even though their currencies have not yet taken center stage in today's narrative. Should that equity thesis gain traction, it could eventually feed into FX through capital flows and relative policy choices, especially where central banks balance support for growth against imported inflation from higher energy and food costs. For now, allocators are watching how the pound trades around upcoming UK data, how the dollar reacts to each new U.S. inflation print and Fed communication, and whether any escalation in geopolitical risk flips current selective risk on FX moves back into more defensive positioning. Commodities, and energy in particular, remain at the heart of the macro story. Escalating tensions between the U.S. and Iran, including strikes and naval blockades, have sharply reduced oil and gas shipments through the Strait of Hormuz to levels last seen during previous conflict peaks, and some Gulf exporters face real geographic limits on rerouting flows. Oil prices have rallied and then stabilized, but forecasts still cluster around crude trading above $80. With 85 as a central scenario, reflecting an embedded risk premium for prolonged, if not outright catastrophic, disruption. The consensus view is that current disruptions may last weeks rather than many months, yet the tail risks are material. A sustained closure of Hormuz or spillover into the Red Sea could push prices sharply higher, and several assessments suggest that a move above roughly $110 to $120 will be the threshold where energy costs start to seriously threaten growth and force central banks into a much tougher stance. European natural gas prices have already doubled since late last year, with storage running below historical norms, and lower-income consumers everywhere are particularly exposed to further oil and food price increases. Beyond near-term oil dynamics, AI and deglobalization are reshaping longer-term commodity demand. AI data centers and electrification are straining power infrastructure, driving interest in advanced nuclear fuel and adding to the case for long-dated infrastructure assets. China's restrictions on rare earth exports threaten trillions of dollars of downstream production, prompting the U.S. to accelerate domestic mining and refining, while pharmaceutical and other strategic industries are reshoring capacity to reduce dependence on single suppliers. These supply chain shifts suggest a structural premium for key inputs rather than a quick return to the pre-pandemic oversupply regime, and they feed back into rates and equities through higher Capex needs, potential margin pressure, and persistent volatility in headline inflation. Across assets, the picture is one of strong earnings and heavy AI-driven investment running into the hard constraints of energy, inflation volatility, and balance sheet risk. Equities are supported by broadening profit growth in banks, capital-intensive sectors, and select emerging markets. But the rally is increasingly concentrated in a small group of AI beneficiaries where valuations, leverage, and policy scrutiny are all intensifying. Rates sit in an uneasy equilibrium. Softer inflation prints argue for patience, while food and energy shocks, plus questions over AI-related power costs, argue for keeping the higher for longer narrative alive. Credit still looks benign on the surface, with robust bank metrics and busy capital markets. Yet widening spreads on AI-linked debt and isolated fund stress highlight how dependent the cycle has become on continuous funding. In FX, a stronger pound and a still supported dollar reflect shifting growth and policy expectations, and commodities remain dominated by Middle East risks, tight European gas, and the structural demand from AI and reindustrialization. Over the coming days, the key signpost for allocators will be hyperscaler Capex guidance, incoming inflation and labor data, central bank communication on the trade-off between inflation control and productivity gains, any change in the duration of energy supply disruptions, and early signs of strain in credit transmission. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.